Good day fellow traders and value investors, and welcome back to another video. Just for reference, the goal of the channel is to analyze stocks as a non-professional and share my findings with you. I also want to make more informed decisions when buying a stock in my speculative portfolio and hopefully find stocks that can be added into my value investing portfolio too. In the last video, we analyzed a company that benefits from volatility of cacao and coffee prices, now to a company that is negatively impacted when the prices of those commodities are volatile. Nestlé. One of the safest, most boring stocks in the market, right? What if I told you that this safe stock might actually be priced in for the recovery that hasn't happened yet? Because when you dig into the numbers, the growth isn't really there. Margins are under pressure, and most of the recent performance has come from rising prices, not actually selling more products. So are we looking at a steady long-term compounder here, or a stock that looks sweet on the surface but has a bitter taste? In this video, I'm breaking it down step by step, using a 3-year scenario model. I will calculate the risk-adjusted return and then confirm it with the chart to see what the market is actually telling us. Let's get into it. So before we jump into the numbers, let's quickly understand what the business actually is. Nestlé is one of those companies that you probably interact with every single day without even realizing it. They're selling products like coffee, Nescafé, Nespresso and Starbucks, pet care, Purina products, nutrition, and food and snacks. Coffee and food and snacks bring most of the revenue to the company, and then it's pet care and nutrition. The coffee side of the business is also high margin and has a strong pricing power. Pet care is one of the fastest growing segment. Nutrition is more sensitive but still essential, and food and snacks is a stable everyday consumption category. It operates global across almost every country with a very diversified product base. So Nestlé is not a growth stock, it's not a cyclical stock, but a defensive consumer staple stock. Meaning people don't stop buying coffee, pet food or basic food products even when the economy slows down. And this is where things start to get interesting. Just because a business is strong doesn't mean a stock is cheap even if it dropped almost 50% from the highs. And that's exactly what we're going to break down next. Over to the financials. First thing to note is that the share buyback program completed in 2024, so there was no return to shareholders through buybacks in 2025. Nestlé returned about 8 billion of Swiss francs in dividends, and the important thing to see is that management is focused to return value to shareholders through organic growth as a high priority, dividends also as a high priority, and debt reduction also as a high priority. They're also saying that if they have spare cash they will do buybacks, and they will do M&A if they will have spare cash as well. And then the headline numbers is that the revenue has been going down 2% compared to 2024 at 89 billion Swiss francs compared to 91 billion in 2024. Operating profit is down as well to 14.3 billion, down from 15.7 billion Swiss francs. And the same for EPS is down, net profit down. Only thing that's gone up is the dividends, 3.10 per share compared to 3.05 in 2024. And then here at the top we can see pretty much all the risks that the company has. First thing is that they've increased their sales by increasing the prices that we consumers are paying. We can straight away see that the growth has happened due to pricing increases, not the volume. Organic growth was 3.5%, but that was offset by the foreign exchange hit, which was 5.7, a negative 5.7%. So total growth was down 2% compared to 1.8% that was 2023 compared to 2024. Now switching to trading view to look at the financials in here, I'll switch to annual straight away, and we can clearly see the downtrend in revenue. It's been going down from 94 billion in 2022 down to 89.5 billion in 2025. And we see the same downtrend in net income, which is obvious, and the same downtrend in EPS, going down from 4.23 to 3.5 currently. Before moving to balance sheet, one more thing I'd like us to look at is the interest on debt. We can see how the interest on debt has been increasing from 800 million up to 1.83 billion in 2025, or what's upcoming in 2026. And this is one risk and one reason why the management is focused on reducing the debt, so they can reduce the interest expenses on debt. Switching to the balance sheet, I'll expand the total liability and we'll look at the non-current debt, and we can see that the long-term debt has been increasing from 23 billion up to 46 billion. One important thing to note as well is the equity has been going down from 36.69 billion to 33 billion. And the key driver for that is the dividends, about 8 billion Swiss francs, FX losses, and lower profits. We can also see that there is an uptrend in the net debt which means that they have more debt than total assets. And finally, over to statistics, I'll change to annual as well. We can see that Nestlé is currently selling for a PE of 22.35, and over the years it's been selling for an average PE of 23, I calculated. And looking quickly at the margins, we see that the margins are under pressure. They've been going down from 49 all the way to 44.58 for current year. Likewise for net margins have been slowly decreasing from 13.6% to 8.57. And then finally, current ratio. Nestle has a current ratio of 0.79, which means that they have 0.79 Swiss franc of current assets for every 1 Swiss franc of current liabilities. And then debt to equity ratio is at 1.76. They have quite a big pile of debt. So as we can see, Nestlé isn't struggling, but it's not thriving either. It's rebuilding, and their story depends on a lot of things going right. Now that we've seen the financial performance of 2025, let's have a look at how much you should be paying for the stock right now. According to Warren Buffett's calculator, which uses the historical book value per share growth, and that was a negative historical book value per share growth, the old one is higher than the new one, we get an intrinsic value of 30.50 Swiss franc per share. Using Phil Town's calculator, which looks at the earnings per share growth for the next 10 years, we get an intrinsic value of 15.77 Swiss franc per share, which is way lower than the current stock price. And then Peter Lynch's calculator is using the PE growth. I use the same growth, and we get an overvalued rating using this calculator. So using the three calculators, we get an intrinsic value range between 15.77 Swiss franc to 30.50 Swiss franc, and an overvalued rating using Peter Lynch's calculator. And for the three case scenarios, I use pricing power versus volume growth. Basically, can Nestlé grow volume again without hurting the pricing? And for the multiples, I use multiple of 17 for bear, that's compression to industry averages, PE of 19, it's less premium but implies stable defensive stock, and multiple of 21 is still premium but below the historical average of 23x for the past 8 years. So in a bear case scenario, with EPS growing at 3%, consumer pushback on pricing, volume growth stays weak, commodity costs remain high, we could see EPS of 3.84 Swiss franc per share, and the stock could be selling for 65.20 in 3 years. In a base case scenario, with EPS growing at 6%, pricing stabilizes, volume growth gradually improves, margins slowly recover, we could see EPS of 4.18 Swiss franc per share, and the stock could be selling for 79.43 in 3 years. In a bull case scenario, with EPS growing at 8%, strong volume recovery 2-3%, commodity costs fall significantly, we could see EPS of 4.43 in 3 years, and the stock could be selling for 92.82 Swiss franc per share. Putting all through a probability weighted table, we see we get a return of 1% over next 3 years, making it compounded 0.36, still almost zero. Dividend is pretty much the only return, 3.99 dividend, that's 4.35 over yearly over next 3 years. Now on the surface this looks like a safe, steady business, but when you dig a little deeper you start to see where the things could go wrong, and some of the risks are not obvious at first. First, pricing. A big part of Nestlé's recent growth hasn't come from selling more products, it came from charging more for them. Volume growth was just 0.8%. And the risk here is that consumers may push back, they either buy less or switch brands completely, and future growth slows. Then there is commodities. Coffee, cacao, the exact things that make this business what it is, are also the things that can hurt it the most. When prices go up, margins get squeezed. Management said this is temporary. Maybe it is, but if those costs stay high for longer than expected, the pressure doesn't go away, it builds. Then there is foreign exchange risk. Swiss franc hurts the reported results. The management is already projecting a negative 6% FX impact in 2026. It had a 5.7 impact in 2025, and that's an increase compared to 2024. And then there's infant formula recall. 2025 impact of the recall was small, but the real impact shifts to 2026. The risk is that it affects brand trust, and lost sales could last longer than expected, and trust takes long to rebuild. And finally, the underperforming segments. 20% of the business was underperforming. Now management is working on fixing it, but turnaround don't happen overnight. Sometimes they take longer than expected, and sometimes they don't work at all. I gave Nestlé a base score of 3. I added 0.25 because the current ratio is lower than 1. I added 0.25 because it has quite a bit of debt. The debt to equity is above 1 as well, and it gives a total score of 3.5. With score taken into account, we get a risk adjusted return of 1.31. That means that Nestlé presents us with a yearly return of 1.31 with risks taken into account. So when you step back and look at it, this is still a strong business, but it's also a business where a lot of things need to go right. So now that we've seen how much return we can get from the stock using our intrinsic value calculations and the risk adjusted reward, let's now put it all on the chart. First thing that we notice that the long-term structure is still weak. The stock is coming out of a downtrend. Whether this is the bottom or not remains to be seen. More recently, the price has compressed into this symmetrical triangle, and one important thing that I can see is that none of the sides have won this battle. Both the bulls and the bears have came in strong. Strong movement up, strong movement down. There isn't choppiness in the movement up, choppiness in movement down. There were both strong moves, strong move down, strong move up, strong move down. And what this symmetrical triangle really means is that there is an area of indecision. Neither the bulls or the bears are certain where this market is going to go. The most important thing to watch here as well is if the price breaks out of the triangle, comes back and tests, and then it can go upwards. Likewise for downwards momentum, if it comes out, comes back and tests it, and it can go all the way down. And the target for this move is this arm of the triangle. If I take my drawing tool and I draw from the bottom to the top, the target is if it breaks, it can go all the way to this 94 level. If it breaks up, if it breaks down, it can go down to this 60 level. Then let's put the risk reward on the table based on our bull base bear case scenario. So if we use the bull case scenario as our profit level, which was 92.85, and then if we put the stop level as our bear case scenario result, which was 65.20, we get the risk reward of 1.1. So with bull case scenario as the profit and the bear case scenario as the stop loss, we get a speculative risk reward of 1.1. Let's bring this all together. Nestlé is not a broken business. Far from it. This is still a high quality global company with strong brands, strong cash flow, and a very defensive profile. But it's also not firing on all cylinders. Growth is slowing, margins are under pressure, and a lot of the recent performance has come from pricing, not real demand. And that brings us back to the question from the start. Is Nestlé fairly valued or overpriced? Based on everything that we've gone through, I'd say this stock is fairly valued, maybe slightly expensive. So for me, this is not a rush in and buy type of stock. It's more of a wait for confirmation or a better price situation. If you enjoyed this analysis and found it useful, hit the like button, consider subscribing, and let me know in the comments what stock you'd like me to analyze next on Fundamentals in Motion. Thanks for watching.